Hello, Michael. Good to see you here. I'm glad that we got together today to talk about real estate and mortgages and encourage our buyers to be out there in the market. My name is Laura Fournier. I'm with Nations Lending. We are a full service lender. We offer loans in all 50 states and we just do residential mortgages. So glad to be here.
Well, it's an honor to be here, Laura. It's our first time together, and I'm really excited about the dialogue and, more importantly, how together as a team we could help not only our clients, but also the general public in terms of educating what we do and helping them out, whether they're first-time home buyers, vacation home buyers, and things like that. And so for everybody out there, my name's Michael Kurtianik with McIntosh Realtors, and been doing this for around 20 years or so. This is my full-time job. I don't have any side hustles or part-time jobs or anything like that. Real estate is all I do. And I've seen a lot. And this year in particular has been quite challenging because we've been facing a lot of headwinds. And so I thought, Laura, maybe what we could do is talk a little bit about one of the biggest headwinds we're facing, and that's inflation. Inflation is a big topic in the media today. What are you seeing in your industry, Laura, about inflation? What challenges are you and your clients facing with that? If you don't mind, just share some with us, and then I'll talk a little bit about the real estate side of things.
Awesome. Yeah, thank you very much. Inflation is definitely probably the biggest topic out there affecting all of our buyers and sellers too, because some people would be afraid to put their house on the market because they're afraid of where they're going to go after they sell their house. It's easy to sell the house, but what do they do next? So it's a big topic, and inflation is a big topic just because inflation is when things are getting out of hand, the prices are going up, and everything is costing more. So inflation is something that's getting bigger and bigger, and it's just a great topic to understand. I'm going to do a little screen share because I got a few PowerPoints to, oops, yeah, you have to enable me to screen share. So, but inflation, just to define inflation, it means that there's a sharp upward increase in prices. And we all know that that is happening because we see the prices of gasoline going up. We see the prices of food going up. We've obviously seen the prices of housing and rents going up over the last several years and going up rapidly. So inflation a couple years ago was at about 1.4, and now we're at 8.5 was July's inflation rate.
Mm-hmm. Yep.
So a little thing that the media was saying that was not true. Did that come? Oh, wait, I have to push, excuse me.
There we go.
One of the things that the media was saying that was there was zero inflation in July. That was actually not true. Inflation was at 8.5%. It just did not increase from June to July, but inflation was not at zero. So sometimes you have to dig a little deeper than the little sound blurbs that they give us when they're talking for 30 seconds or whatnot. But inflation is what really drives interest rates. Interest rates absolutely follow inflation, and I'm going to show you this in this chart. And you can see that inflation just drives interest rates. They just follow each other along. They very rarely track differently than one another because mortgages are a very long-term product. 30 years for the majority of mortgages. Yes, you can get 15 or 20 or even 25, but the majority of people take a 30 years. So that's a very long time for a lender to have money out there as a loan on a fixed interest rate. So when things start costing more and there's going to be more business expenses, employees cost money, lights cost money, buildings cost money. They know that that interest rate that they put on the books at 2, 3, 4% is not going to cover their expenses. So they have to raise up rates because they know their expenses are going up. And it's really just that simple. So as inflation goes up, interest rates are going to go up. And it's just really too much dollars because the government has been spending like a bunch of drunken sailors, too much money out there chasing too few products. So, and it's economics 101, supply and demand. Too much demand and too little supply drives up interest rates. So what has the Fed done? The Fed increases the Fed funds rate, which is really just the overnight rate that banks that are part of the Federal Reserve System can borrow money on an overnight basis, super short term overnight. But every time the Fed hikes interest rates, and you can see it on the chart, generally speaking, all of these hikes have been corresponded or preceding it, not preceding it, right after they start raising interest rates, we cause a recession in the economy. And every time they've raised rates, a recession has ensued shortly thereafter, little tiny one in 2020.
Yeah, so on that point, Laura, it does seem that the mortgage interest rates seem to anticipate when the Fed hikes the interest rates that they charge banks on overnight rates. And so there's an anticipation of that.
There's definitely everybody that's on the secondary, the backside of mortgages and the pricing, they are always trying to, anticipate what's going to happen and where the economy is going, how things impact the economy. And they're definitely trying to raise rates ahead of seeing these things. But in the short run, yes, they raise up interest rates, but then after they see that the Fed, by raising rates, is also slowing down the economy, which is what causes the recession, the mortgage rates will start pulling back because it should bring down some of the demand. It should take some money out of the economy because what is going to happen is that the short-term rates, auto loans, personal loans, home equity lines of credit, commercial loans, which are shorter term loans, there'll be less demand for that because they're going to cost more because the Federal Reserve is raising interest rates. So that should push down demand some and then slow down the rate of inflation, which brings mortgage rates a little bit back in line. And we have seen that this week and last week, that actually mortgage rates got better. So a little bit better than they had been. So and we are officially in a recession. Again, by definition, 2 months of negative, not 2 months, 2 quarters of negative gross domestic product equals a recession. So mortgage rates usually during a recession actually get better. Mm-hmm. So the Fed raising rates helps mortgage rates because it pushes down inflation some, and the recession pushes down recession a little bit and demand a little bit, and then mortgage actually start getting better. The rates actually start getting a little bit better. And I don't have a chart for it because my internet went down, so I couldn't pull a current chart, but we are actually in what is considered a range that's still historically low. We are not as low as we were the last couple years, in the 3s and the 4s, but rates in the 5s is still very low interest rate and very reasonable for people to be able to afford to buy a house at that interest rate.
Right, so, and right there, Laura, you can see on your chart that prior to the pandemic, interest rates were around 4.5%-ish. Mm-hmm. During the pandemic, the government took steps to drop those, to do things so that the mortgage rates dropped to 2.75 to 3.75%. And now we're hovering in the 5% range. So if we took out the pandemic era and we just looked at pre-pandemic and today, it's really only about a half, 3/4, maybe a 1% increase in the interest rates. Do I have that interpretation correct?
Yes, absolutely. So, I mean, it was more dramatic because we were really in the upper fives, sixes, but now it's pulled back. So we're in the lower fives. So we're really in a very normal interest rate cycle. Yeah, like you said, and it was perfect that you said it that way. When you pull out the pandemic, which is totally an unusual, unprecedented event, then we're really in very normal interest rates, actually a little bit low. They've been tracking interest rates for several centuries, and a 30-year average I read was 6.657.
Yeah.
But anyways, still very reasonable. I always like to tell, I bought my first home at 11%.
Yeah. Yeah.
So
That's right.
twice what we're paying now.
Yeah.
So,
Yeah,
and
that's right. And at granular level, the shocking change is that, this time last year, a first time home buyer, at the interest rates, they were looking at a house around 325,000. But today with the interest rates, they're looking at around 260 to $270,000 in terms of the first time home buyers buying power. So on the real estate level, I know I've had to make adjustments with my buyers who were beat out by the low inventory that we have and the numerous buyers and we were beat out by cash buyers, but now the buying power is kind of adjusted. We're looking down below the 300 range than we were like 12 months ago.
yeah, and it's just very important for people not to try to time the market and also not listen to a lot of the naysayers and really get advice from somebody that's been in the industry, that works in the industry full time, that can give you good, solid charts to explain and educate about, where the industry has been, how one thing affects the other. And you're making a really educated decision when you get this kind of advice from, seasoned professionals that we care about our clients and we want them to understand the value of home ownership. And even if you say rates go up again and you're 6-7%, if you can afford to buy, you can afford the payment, then it's a good time to buy. Because you maybe marry your house, but you date your mortgage, because you can refinance that mortgage and get a lower interest rate during the times that rates are declining. And that's what happened, with my family. We refinanced that rate. My first house I sold, so I never refinanced that mortgage, but I sold it. My second house, I was at 9 3/8, and then rates started coming down and I refinanced it to 7 point something. And I might have refinanced that one twice before I actually sold and moved to another house. But, you only are in that mortgage as long as you need to be. If rates come down and there's a good savings, then your lender or myself will be calling you and saying it's good time for you to save some money.
Right. And I want to further the point, and Laura, you did this really well with your clients, and that is when it comes to identifying a property, the interest rates fluctuate on a daily basis, just a little bit, but not a lot. But you are able to provide our clients with information on two fronts: what the estimated closing costs are based on that home, taxes, HOAs, whatever, and also the estimated monthly mortgage based on their loan package, what they can deposit and put down as a deposit, and things like that. So one house 6 months ago that was for 300,000, they could come in at X, but today, because interest rates are higher, Now the estimated closing costs and the monthly mortgage is now Y. It's different than it was.
Mhm.
And so having that information is really valuable to buyers of homes so that they know if a home fits within their household budget.
Right, exactly. And we will share all the options because there might be 2 or 3 mortgages to pick from, different structures, different down payments, and we'll use the money available wisely because maybe less down payment and paying off some consumer debt makes more sense in their overall cash flow. And we will look at all of those things and educate the buyer about, how this mortgage is going to fit into their financial plan. Because it really is the kingpin, the cornerstone of your financial plan, because it's your biggest asset, but it's also usually your biggest debt. But it's a great time to buy. People shouldn't be panicked because they hear 5 or 6%. It's excellent rate, and these are still fixed rates, so your rent can vary, and rents we know are accelerating even faster than housing prices right now. And it can fix in your monthly cost for your housing by
Mhm.
buying. So it gives a lot of stability to a family on a lot of different levels.
Yep,
Good
agreed.
time to buy. And even though we hear scary words, inflation and recession, housing and interest rates are actually usually, historically speaking, very stable during recessions. You have to live somewhere.
Right.
Might as well live in a house that you own.
Yep, I'm with you on that. And your point is well taken that some of my clients, some of our clients, they say, okay, I want to time the market. I want to put my house on the market, on this day, but I'm going to wait a little bit and maybe I'll do it like later this year. And I tell them, listen, I've been doing this for over 20 years. I can't time the market. I all I can say is that we may face unknown headwinds in the next 30 to 90 days that we just didn't anticipate. So the best thing, so what I tell people is this: the best thing you can do is simply have an honest conversation with whoever's in your, making the decision, and you make a decision whether now's a good time or we wait a little bit. And the best I can do is give you advice, but they have to end up deciding what they should do.
I can say everybody that has waited over the last years is very, very sorry they waited, because housing prices are up, interest rates are up, which means your payment is more, and you're paying more to get the same house, or you're paying more and getting less house. And we are literally still in a very big housing shortage. There's not enough houses being built or rebuilt to keep up with demand. So this is a real boom in housing, but it's pushed because there's a shortage of houses. So, and they're looking out even 5 years and they're seeing regular, normal appreciation, 3 to 5% in almost all areas across the country. So we have a dip in interest rates right now this last month. If the Fed is likely to raise rates again in September, they meet on the 21st. They're looking at a half to another 3/4 point increase in that Fed funds rate. If that keeps inflation in check, we'll probably see rates either staying where they are. They could get a little bit better. I don't know. The federal government is spending another big truckload of money, so that could be inflationary, probably will be. But if you can afford to buy now, put in your best offer and enjoy your home. I've bought and sold in every market, and I've never been unhappy that I owned real estate.
Yeah, yeah. I think that's a great point, Laura. And what I tell my clients is, you just make the best decision you can at the time, and whatever will be, but you can control what it is. The inventory is really low this time of year. Now, I'll throughout this number. In where my focus is in Western Maryland, you know, I'll pick Frederick County, for example. A balanced market is one where we have about 1,100 to 1,200 homes on the market. As of this morning, as of this taping, we barely have 500 homes on the market in Frederick County. Of those 500, about 35% are new homes. And those will be delivered till the end of this calendar year in the beginning in the first quarter of 2023. So not a lot of houses on the market. Yes, August is kind of a slow month right now. You know, school year is about to start, final vacations, et cetera, et cetera. But the low inventory and the lack of supply of new homes has really caused a strong headwind. Couple that with our topic today of inflation, the people are really concerned about, you know, the rising costs of, you know, the groceries. Gas is going down, but some things are on the uptick. So buyers are facing a lot of headwinds. And so if anybody has any questions, please consult a professional realtor, please consult a professional lender, and just have that confidential conversation and just see what's in your best interest. And we can help you with that.
Absolutely. We will help them, you know, we can review their budget and talk about, you know, if things went up a little bit, do you have enough slack in that budget to still maintain, you know, your way you spend money and the way, you know, you want the things you want to do. And if the answer is still yes, then it's a good time to buy.
Absolutely. And I think that's a great place, I think, Laura, to end our conversation today. Do you want to add anything else for the good of the cause?
I would just say that please reach out to either one of us and we will be happy to answer any questions, address concerns. I always will provide all the information, education, and communication that is needed to help you make a great decision. And my contact number is 301-674-7716. And I'm available days, evenings, weekends, holidays. Love the business and love to talk about it. And we hope to help you buy your dream home in the near future.
That's great, Laura. And as for me, thank you for watching this. Please share this video with anybody who you think might benefit from watching this. Laura, thank you for the opportunity. I can't wait for us to do this again. If you need me, I'm at 301-401-0039. Be happy to help with a consultation. So thank you so much, Laura. And until next time,
Thank
do
you.
your best.
All righty.
Take care.
Bye-bye.